Greetings and welcome back to Visionomics. We discuss all aspects of business and investing on this channel. Today's video reveals another huge corporate scandal that cost the victims billions of dollars in losses. This time, the culprit was Autonomy Corporation, the largest software provider in England. The Autonomous firm produced business software for handling massive amounts of data. Everything you may anticipate from a high-tech data analytics company was included in their goods. Their software is used by a wide range of businesses for corporate search and pattern recognition, enabling them to make advantage of unstructured data sources including emails and audio transcripts. Despite being widely recognized as England's finest software company and enjoying high-profile success, the corporation was accused by the SEC of engaging in a significant accounting fraud over a period of years prior to its unfortunate acquisition by Hewlett-Packard. Due to this deception, HP overpaid the company by several billions of dollars, taking an almost immediate $8.8 billion loss on the deal. We'll discuss what exactly transpired in this video, including how much money HP shareholders were duped out of. In the 1990s, Autonomy was established in Cambridge, England. They initially concentrated on creating high-tech software for specific purposes, such as pattern recognition and digital search. They were first separated from Cambridge Neurodynamics, another company, which concentrated on computerized fingerprint identification. They were connected to the renowned research facility. They gained prestige and the intellectual capacity to create cutting-edge technologies thanks to Cambridge University. Additionally, they embraced a ruthless corporate culture in which they fired the bottom 20% of its staff annually. On the other end of the scale, they treated their top employees well and gave them generous bonuses. This was a reflection of management's idea that workers were merely resources for the business. These elements helped the business outperform its rivals and prosper because their value was based purely on how productive they were for the business. In the 2000s, the business bought numerous smaller firms. By 2010, just 12 years after its founding, it had grown to be the UK's biggest and most prosperous software company. In the meantime, Hewlett-Packard, HP, was having trouble in the US in the early 2010s. Due to the rise of smartphones and, to a lesser extent, tablets, its primary business of selling personal computers was deteriorating. Following a terrible quarter, HP fired 27,000 employees in the beginning of 2012. A string of unsuccessful purchases were also hurting HP's financial situation. Included the $1.2 billion it paid for the mobile phone manufacturer Palm in 2010. Before the popularity of the iPhone, Palm created a number of smartphones that saw brief success. HP purchased Palm at the height of its commercial success, but failed to successfully integrate it into its ecosystem of other purchases. HP sacked and hired numerous CEOs in the 2 years that followed, and the stock price fell. In 2010, it also sacked CEO Mark Hurd and appointed temporary CEO Cathy Lesjak, the CFO. A few months later, Leo Apotheker received the title of permanent CEO. He was likewise sacked and replaced by Meg Whitman less than a year later. At the same time, in a last-ditch effort to remain a viable tech firm. At the time, HP disclosed that it has made a startling $10.2 billion offer for an 87.3% interest in Autonomy firm. HP paid nearly to an 80% premium over Autonomy's market value because the stock was trading at roughly a $7 billion market cap. The purchase was quickly authorized by the Autonomous Board of Directors. The agreement was unanimous, and the purchase was completed less than a year after the acquisition in October of 2011. The company's founder and CEO, Mike Lynch, left. After a successful career as a tech entrepreneur, he was already a billionaire by this point thanks to the sale of his company to HP, and he undoubtedly intended to cash out. However, as would soon be revealed, there might have been more to his need to leave the ship. A half year after Mike Lynch's departure from his position as CEO of HP's Autonomy, HP disclosed to its shareholders that it had to write down the Autonomous acquisition by $8.8 billion and suffer a loss of more than 85% on the $10 billion transaction. Prior to HP's bid to buy Autonomy, Autonomy, according to HP, made a conscious effort to deceive HP. HP's CEO claimed that Autonomy's business was significantly less successful and profitable than they had been made to believe. For instance, during the acquisition's due diligence process, some hardware purchases were accounted for as software sales. Sales of software are often thought to be far more desired than those of hardware, because software might have profit margins that are almost 100%. Furthermore, one of the main, if not the main, reason is that HP originally sought to purchase Autonomous was because it intended to move away from selling hardware like computers and toward a more software-focused industry. Autonomous intentionally inflated its income and created the appearance that it was more profitable than it actually was by reporting hardware sales as software. According to HP's CEO, Autonomous had profit margins in the extremely high 40 to 45% range, whereas HP later found that they were actually closer to the 20 to 28% range. Mike Lynch, the originator of Autonomy, refuted the claims. He asserted that prior to purchasing Autonomy, HP was in charge of conducting all essential due diligence on the business. Furthermore, he charged that HP was using Autonomy as a smokescreen to hide its own dismal financial performance. After all, the choice to buy Autonomy was a component of a long-term strategy to leave the hardware industry because I was not performing well in it. On the news, that HP was taking this write-down of a loss on Autonomy, resulting in a more than $6 billion corporate loss on the quarter. HP stock tanked 12% in a single day. That destroyed billions of dollars of shareholder value almost immediately. Regarding HP's allegations of Autonomy, fabricating false sales and profitability figures, both the SEC and the FBI took notice. The UK's regulator likewise launched an inquiry into Autonomy. After years of conflict between the Autonomy's former and current management and the regulators, the UK case was concluded. The American regulators, however, continued their investigation until 2016. The SEC came to the conclusion that Autonomy had committed financial fraud. A cease and desist order was obtained against a senior executive at Autonomous. Christopher Egan, who is in charge of fabricating Autonomy sales, was informed that HP was thinking of making an offer. Egan oversaw sales and served as CEO of the US-based affiliate of Autonomy. The scam, which was carried out at the behest of other high-ups in the corporation and involved the main subsidiary, comprised inflating and backdating sales and making use of what are known as value-added resellers. Autonomy would seek out potential users of its software and start the sales negotiation process. While the discussions were taking place, Autonomous would offer the software to third-party resellers and project how much money they would ultimately make from the deals. These resellers received payment from customers solely to buy the program on paper. They had no interest in the product whatsoever. If the transaction with the actual customer was successful, eventually, the third-party company would deliver the item to them, and the actual customer would then reimburse the third-party company. Autonomy would be able to do this so that it could record the revenue from the transaction months before it was officially signed. Sometimes the transactions might fail, forcing Autonomy to incur a loss by repaying outside businesses. But in certain circumstances, the revenue reported would continue to exist. This accounting method was commonly used by Autonomy to guarantee that, when reporting results, they always met analyst expectations. Also to hasten revenue forward from the time the contracts were actually signed. When this was not sufficient, however, Autonomy occasionally outright reported sales for a financial quarter that were actually made after the quarter had ended. This clearly violates securities law and allowed Autonomy to establish a multi-year track record of consistently exceeding analyst expectations. Autonomy was also able to bill some hardware sales as high-margin software sales through various accounting irregularities. As a result, the deception was continued. In addition to being required to discontinue all dishonest business practices, Christopher Egan was also forced to pay the U.S. government a fine of about $1 million. Christopher Egan paid the fine and acknowledged being found guilty. Similar conclusions were reached by the U.S. Department of Justice and the SEC. But creator Mike Lynch never faced charges. Instead, the authorities only had enough proof to indict CFO Sushi Van Hussein. However, the HP stockholders were never given any money in exchange for the losses they suffered throughout the acquisitions. HP stock has only lately recovered to its pre-disastrous acquisition of Autonomous levels. Okay, guys, that concludes this video. Please give the video a thumbs up if you liked it and subscribe if you did, so that you won't miss any future videos. Also, feel free to remark on what you think about the former largest software firm in the UK. Thank you so much for watching in the interim. We'll see you in the next video. Visionomics, I'm done.